In this lesson, we're going to review the four formations, and you can see them on the right-hand side of the screen. The first one on the top is a RBD, that's a rally-based drop. The one beneath that is a DBD, which is a drop-based drop. Both of these two formations are bearish formations. Now, the two formations below them, the RBR, which is a rally-based rally, and the DBR, which is a drop-based rally, these are two bullish formations. Now, what makes these two makes each of these formations either bullish or bearish depends on the leg out candle. If you look at these formations, each of them has three parts. The first part is the leg in candle, the second part is the base, and then the third part is a series of leg out candles. So you have a series of leg in candles, a base, and then a series of leg out candles. The leg out candles are what determines what type of formation it's going to be, and the leg out candle also determines the type of unfilled orders that are going to be left at the base level. So if we go through each one of these, the first one on top, you have a rally-based drop. And the rally-based drop occurs when price rises, bases, and then drops away from the sideways basing. The drop from the base represents imbalance and shows there will be unfilled sell orders left at the base. This is also considered a reversal formation because price rises, it bases, then reverses and heads the opposite direction. Next, we have the drop-based drop. This formation occurs when price pauses after a decline in price and then continues to decline after the pause, leaving behind unfilled sell orders at the base level. The drop-based drop is referred to as a continuation formation, indicating buy orders are outweighed by sellers, and the sellers control the movement of price. The action we typically take, or that we will take, at either supply formation is a put option or a sell short order inside the zone. Now, the next two formations, the rally-based rally and the drop-based rally, these represent demand zone formations. And these, again, are our two bullish formations. A rally-based rally occurs when price moves up, begins to base, and then rallies out of the base level. When price rallies away from the base, it leaves behind unfilled buy orders at the base level. The rally-based rally is referred to as a continuation pattern because price continues in the same direction that it was moving in before the basing began and after the basing is done. Next, we have a drop-based rally. The drop-based rally is considered a reversal formation because price reverses direction in creating the formation by dropping, moving into a sideways base, and then price turns and rallies to the upside. Price moving higher away from the base signals there are no more sell orders left and buy orders are remaining at the base level. The action we take for either demand formation is a buy order at the base level. So we have four formations. Each contains three elements. You have the leg in candles, you have a base, and then you have the leg out candles. Two formations are bullish and two formations are bearish. Two formations are reversal patterns and two formations are continuation patterns. Now, in the next video, we're going to go through a lab going through the 5-step zoning process on a chart in order to identify each formation, one formation at a time. Hope to see you in the next video.